Hello, today we're diving into DSCR loans for rental properties. You'll learn what they are, how they work, and how to get the best loan terms. Whether you're a seasoned investor or just starting out, understanding your loan options is crucial to growing your real estate portfolio. In this video, we'll teach you how experienced real estate investors use high leverage to buy more rental properties. You'll be able to leverage your rental property income to secure financing and continue growing. We'll break down what DSCR loans are, how they work, and I'll share some insider tips on how to get you approved. We'll also dive into why investors work with private money lenders and how to ensure your application stands out. We've included all the topics in the video description below, so you can easily skip to the information you're looking for. There you'll also find links to resources, including a DSCR loan calculator and additional content to help you on your journey. At the end, we'll provide actionable tips and a handy tool that can help you calculate your potential loan amount directly. So let's jump right in. So what's a DSCR loan? When it comes to real estate investing, using the right financing options can make a big difference. One such option is a DSCR loan, which stands for Debt Service Coverage Ratio Loan. This type of loan is designed specifically for rental properties. The unique aspect of a DSCR loan is that it focuses on the income the property generates rather than just your personal income. This means that lenders will look at the rent money your property brings in and compare it to its monthly debt obligations. In simple terms, if your rental property earns more than it costs to maintain the loan and other property expenses, you're likely a good candidate for a DSCR loan. This makes it an appealing option for investors who don't have a steady personal income stream but can find profitable investment properties. Now that you understand what a DSCR loan is, let's dive into how DSCR is calculated. The DSCR formula is fairly straightforward but critical in the evaluation process. The formula for DSCR is gross operating income divided by total debt service. Gross operating income is the rental income that your property generates, while total debt service includes annual property taxes, annual landlord insurance, monthly HOA fees, if any, and any loan payments such as principal and interest. For example, if your property brings in $10,000 a month in rent and you spend $5,000 on operating expenses like property taxes, landlord insurance, and loan payments, then your DSCR calculation would be $10,000 divided by $5,000, which equals 2. A DSCR of 1 or above means you're generating enough income to cover your loan payments. In this case, a DSCR of 2 suggests a comfortable cushion, meaning your property generated 100% more income than what is necessary to repay the loan, which makes you a more attractive borrower to lenders. This ratio helps lenders assess the risk of the loan. The higher the DSCR, the lower the risk for the lender, and the better the chances of your loan approval. Let's see how the DSCR loans work. The process begins when the investor applies for a DSCR loan. Lenders will first run the DSCR loan calculation to make sure the property generates sufficient rental income to cover the loan payments as we discussed earlier. Lenders will then ask for your company documents like your articles of formation, operating agreement, and EIN letter. If the DSCR ratio meets the lender's threshold, often a minimum of 1, your credit score will be pulled. Typically, this will be a hard pull. However, some lenders run a soft pull. Remember, the higher your DSCR, the more secure the loan is from a lender's perspective. Some lenders have no minimum DSCR, but higher DSCR comes with more favorable loan terms. If underwriters approve everything, they'll proceed to the closing process, which involves finalizing the loan terms and signing the necessary paperwork. A streamlined focus on property income over personal income makes DSCR loans particularly appealing for investors who don't have a stable personal income but want to invest in real estate. So who uses DSCR loans and who's eligible? Seasoned real estate investors are individuals who have extensive real estate portfolios and understand how to leverage DSCR loans to expand their portfolios without being limited by their personal income. New investors who want to buy investment properties without relying on the limitations of traditional banks. Many new investors go with traditional banks just to lose out on many deals since they're competing with cash buyers. DSCR loans allow new investors to scale their real estate business faster without limitations. A credible tool for anyone considering a DSCR loan is the DSCR calculator. The DSCR calculator allows you to input the rental income of your property, operating expenses, loan amount, interest rates, and any other relevant info. Then it will calculate everything automatically. This tool is incredibly useful because it gives you an idea of what a lender will see. By understanding your property's DSCR in advance, you can increase or decrease the loan amount to play around with the DSCR ratio to get approved. You can find a link to our DSCR loan calculator in the description below. I encourage you to play around with it and see how different loan amounts affect the ratio. Here are some helpful tips to increase your chances of getting a DSCR loan approved. First, if you own the property, consider making upgrades or improvements that justify a rent increase when it comes to the appraisal. Higher rental income can significantly improve your DSCR. Next, pay off any personal debt or refinance your credit cards and wait 1 to 2 weeks to bump up your credit score. Also, make sure to close before the 30th of the month to minimize your prepaid interest at closing. So now that you know what are DSCR loans, this is how to get approved for one. First, maintain a good personal credit score. Even though the loan is based on property rental income, a strong personal credit score reduces your borrowing costs, such as interest rate and closing costs. A higher credit score improves your DSCR ratio since higher credit scores typically get lower interest rates. And this means lower operating costs. Choose the right lender. Different lenders have different requirements and specialties. Go with a lender who specializes in DSCR loans and works exclusively with real estate investors. By following these steps, you'll not only strengthen your loan application but also position yourself as a credible and reliable investment partner in the eyes of potential lenders. Thanks for watching our video on DSCR loans for rental properties. If you found this video helpful, hit the like button and subscribe to our channel. Thanks again for watching and see you in the next video.